You're listening to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN E-Mini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN E-Mini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things E-Mini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Bork. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon. Welcome back. Today is Tuesday, 13th day of April, 2021. Thanks so much for joining us. Whoever you are, wherever you are, we're just glad to have you right here, right now. If you can't see the screen I have up, go to our homepage at cfrn.net. On the right-hand side of the page, click the big microphone, follow the instructions. You'll be registered in about 30 seconds, and that will give you one-click access to the show each and every day. On the days you're out of the office, away from the desktop, you can point any internet-connected browser to cfrn.net/live. And there you'll find a live, real-time simulcast of the show as it unfolds. You just won't have access to the chat box. We do stream live during this broadcast on our YouTube channel, which is youtube.com/CFRN. We also archive each and every daily show there, and there are currently over 1,600 daily shows archived for your viewing pleasure. With that, let's open with a word of prayer. Heavenly Father, we thank you today for your blessings, for your mercy, for your grace. We thank you that you do hear and answer our prayers. We pray today that you would hear our prayer and be in the midst of our meeting. Thank you that your presence calms the troubled sea of life, speaks to our very souls. We pray that you give us clear minds and peaceful hearts as we gather together today. According to your abundant mercy, you have caused us to be born again into a living hope by the resurrection of Jesus from the dead. May we live in the light of your salvation, experiencing the freedom that is ours in you. This we pray in Jesus' name. Amen.
Amen.
Happy Tuesday. Let me give you the numbers real quick from around the world. These are the cash markets, or the indices as they're called. Starting here at home in the U.S., the Dow is down 140 points. The NASDAQ is up 77. S&P 500 is up by 5. And the Russell 2000, our man in the street, down 16. And here we are with another week of that divided index movement. Historically, over the years, it is most common to see the Dow, the NQ, the S&P, and the Russell trending basically in the same direction. They're all in the red or they're all in the green, but these last few weeks here, as we've been battling it out at the top, looking for that new all-time historic high that sticks for more than a day, we've seen division in the ranks. Again today, NASDAQ, S&P in the green, Dow and the Russell both in the red. In our commodity basket, crude oil up 65 cents, trading 60.35 last. That's a gain of a little over 1%. Gold up $11.10, trading 17.4380 last. Silver up 54 cents, trading 25.41 last. That's a gain of a little over 2%. And a reminder that with silver, when the price of silver moves $1 in price, that translates into $5,000 profit or loss if you're holding one large silver contract. And so, with silver being up 54 cents on the session, that's a potential gain of a little over $2,500 per contract traded. In the Asian markets at the close, Nikkei posted a gain of 212 points. Shanghai dropped 16. The Hang Seng rose 43. And in the European markets at the close, FTSE up 1, the DAX up 19, CAC up 22. Pretty light trading. That gives us a mixed day in Asia. It's a green day in the UK, and it's a mixed Radio Tuesday here in the US of A. So with that, we'll go to Michael and get a recap of everything that happened this morning in the live training room.
Okay.
When I come back, we'll take a look at the sideways markets. We'll go through the charts. We'll look at the logic alerts, the concierge alerts, and we'll talk about what the future possibly holds for these markets. There's a top coming at some point, a top that's going to stick for more than a minute. All that and answers to your questions when I return. Michael, it's all yours.
All right, here we go. Good afternoon, everyone. Today is Tuesday, the 13th day of April 2021. Now, if you have not taken your free trial yet at CFRN and you want to, go to the homepage at cfrn.net. Right here, it's going to say free 5-day trial, no credit card required. Click on that. It's going to bring you to this page, eminitrainingschool.com. On this page, all that we ask for is your name, your email, and your phone number. And you can tell us your biggest trading challenge. So we can tailor one-on-one trading just for you. Hit the send button. You'll be sent a confirmation link. You must click on that confirmation link. Okay. If you don't click the link, we don't know that you took the free trial. So you got to click that link. All right. Recaps. If you're going to read the spreadsheet, you got to read all the CFTC risk disclosures down at the bottom. Today, as I said, is the 13th day of April, 2021. Today we made 23 ticks in crude, 9 ticks in gold, and we lost 2 on the ES. Put us at plus 295 on the morning session. Today it took 46 minutes and 9 trades to get to the goal for the day. At that point, we're up $125 a contract. And we took a total of 13 trades. So on the month now, we're at $4,807. That's over 8 trading days, averaging $600.94 per contract per 2-hour trading day. We've now gone 68 out of 69 possible days this year, getting the goal. And on the year now, we're at $57,510. That's over 833. That's over 69 trading days, averaging $833 per contract per 2-hour trading day. Okay, we had a little bit of a rough day today, but we'll get into that right now. Okay, I'll start out with the ES because ES was the worst out of all of them. And you can see right here that this is just garbage. There's just no trading that. We tried our first trade here this morning. We stopped out -8 ticks. Next trade was +2. The next trade was +4. That put us at -2 on the morning session. Next trade we missed. And missed that one. And then I was just done with the ES because it just couldn't establish a trend one way or the other. You know, right here, all this kind of stuff right here. It whips to the upside and then back down. I mean, this isn't really a whip, but a move to the upside and then right back down. You know, that just suggests you should switch to another market. There was just nothing during the break and nothing much during the morning session. Okay. Crude wasn't much different. Crude started out, let's see, well, actually crude was the one where we made the most today, but crude started out right here really choppy and sideways, like the first half an hour. Then it started to move. In our first trade here, we picked up, what did we pick up? 1 tick on that. Break even there, 5 more there to get us to +6. Then right here, we picked up 12 to get us to +18. 1 to get us to +19. Then a break even there, and +4 there to get us to +23. Now, I highlighted these areas for crude to go to, but we just weren't getting the trade setups. You know, we were getting the areas, we just weren't getting the trade setups. And during the break, there really wasn't anything that you could do during the break. All right, on gold, it was similar. See, we had this huge move down here on gold. We didn't get a trade set up all the way down, and it wasn't a fast move. It was a relatively slow move. We couldn't take this short right here because we hadn't broken dynamic support yet. Otherwise, we would have been able to take that. But it started out all choppy and sideways too. And we took our first long trade right here. We were good for 3 ticks on that, 2 ticks on the second one to get us to +5. Then down here, 4 ticks to get us to +9. And that was it for the gold. It was just that kind of a day today, sadly. There wasn't much to do. Okay. And, well, that was how we ended our morning session. I know this is a really fast recap of the morning session, but it is what it is. You know, the markets just weren't giving it up. And, you know, part of it, I think, is because Bitcoin is making new all-time highs today. And so the money's not going into the futures markets. The money's going into Bitcoin and crypto markets, for that matter. Anyway, when you look here at the spreadsheet, you got to read all the CFTC risk disclosures down at the bottom. Today is the 13th day of April, 2021. We made 23 ticks in crude, 9 in gold, and we lost 2 on the ES, put us at +295 on the morning session. Today it took 46 minutes and 9 trades to get to the goal for the day. At that point, we're up $125 a contract, and we took a total of 13 trades this morning. On the month now, we're at $4,807. That's over 8 trading days, averaging $600.94 per contract per 2-hour trading day. We've now gone 68 out of 69 days of getting our goal on the year, and that puts us at $57,510 a contract. So over 69 days, averaging $833.48 per contract per 2-hour trading day. Okay, that's 1 contract, 2 hours a day. And that's it, guys. To take a free trial, go to the homepage at cfrn.net. Scroll down where it says free 5-day trial, no credit card required. Click on that. It's going to bring you to eminitrainingschool.com on this page. All that we ask for is your name, your email, and your phone number. And you can tell us the biggest training challenge so we can tailor one-on training just for you. Hit the send button and you'll be sent a confirmation link. You must click on that confirmation link. Okay, if you don't click the link, you don't get the free trial because we don't know that you took the free trial until you click on that. All right? All right, that's it, guys. With that, we can pass it back out. Studio A, fabulous Phoenix, Arizona, overlooking South Mountain, America's largest city park. Dwayne, if you are ready.
Yes, sir.
So did you get your AC fixed?
Ready. Yeah.
There it is.
Yep.
I can see it.
Got it fixed. So hopefully it'll see me through the summer, at least.
Hopefully.
If I can get away with one annual visit from the AC man, that's a blessing. So, recap of the recap.
Today it actually took 46 minutes and 9 trades to get to $125 a contract.
Or as we say, it takes as long as it takes.
That's right. It took a while this morning. It was just slow. Right in the very beginning, it was really slow.
Well, guys, as long as we're dealing with this is, I've honestly never seen anything exactly quite like it. Well, I don't know. We had, like here, we had a new all-time closing high, closing high, closing high. And then we had some sideways days and some more closing highs. But this is about as an extended a move as I think I've ever seen. This is a daily chart.
Move.
Yeah, let me refresh this chart so sure it lays out right. Yeah. So the new all-time historic closing high yesterday was 41.22 half. Previous day, Friday, we closed at 41.14. Then we closed yesterday at 41.22 and a half. And our high today so far looks like 41.25.75. Now we've got a 38% Fibonacci price extension right overhead. We talked about this yesterday, as that being the next area for potentially some resistance. And the way we arrive at that is we use the Fibonacci price extension tool to connect the low at the end of October, 1st of November, to this high, which isn't quite perfect, but again, fibs are an area, so it doesn't have to be exactly perfect, but we'll tighten it up a little bit here. It is close to perfect. Yeah, without worrying about it too terribly much. And so what that does is it uses the same golden ratio, Fibonacci math, 14th century math, to project into the future where the market may find resistance. The typical Fibonacci retracement tool uses that math to determine where the market may find support on a retracement. Now, over the years, we've not used the price extension tool that much because usually when you get to a new all-time historic high, you go into a retracement that lasts days, weeks, months, and then slowly you creep your way back up, with a leg and a retrace and a leg and a retrace. But this time, it's just day after day after day after day, day after day after day after day. So now we've got to do the same thing we did yesterday. We've got to embrace this new intraday high, which is 41.27. The intraday high yesterday was 24.5. So we'll take this, we'll just ease it up to right there. And then this other line, okay, this is the fib tool you're probably more familiar with. It's the Fibonacci price retracement tool. We try to drag that up. There we go. Now, what that did was it took this, what I just moved, it changed this 24% fib retracement of the entire move, moved it up just a couple points, and this 24% retracement of just the last leg up, it took it just a few points higher. So what we have is a new all-time historic intraday high. We don't know if it'll be a closing high, but we do have a green body on this very small candle. When the markets opened, we came down. The bottom of the green body, that's where the markets opened last night. We dropped, and the low was 41.01 and a quarter, which is right here. So price dropped pretty good. It hit the step line, which acted as good support, sent us back up. And so overhead for resistance, if you want to write these numbers down, today's high, 41.27, that's the immediate overhead high. We're at 25 and we're at 25 right now. So your first major resistance, and I call it major resistance because we're looking at the daily chart. The larger the time frame, the more important the information. If we can get through the high of today, then we have the 38% Fibonacci price extension. If we find a top that sticks on the way down, blue and climbing, that is potential support. And then if we drop a little more like we did earlier in the session, the step line, that's potential support. If we trade below the step line, then the first area that we would expect to find good support would be at the 24% fib retracement of the last leg up. And the last leg up is defined by this low put in on March 25th and today's high. Here's the 24. Here's the 38, the 50, the 62. And as I've said on a number of occasions here of late, this area I find interesting because we spent 1, 2, 3, 4 sessions trying to get through that area. Couldn't do it. Took a breather, pulled back to the BBC, found support, and bounced to the step line, and then pulled back again to the BBC. And this time we bounced through the step line, through red and falling, back to this same area, and again spent 1, 2, 3, 4 days trying to close above it. So we had 4 sessions here, 4 sessions here. So it took 9 sessions, not counting the ones of the pullback, to actually get above this area and begin this climb. The 62% fib retracement of the last leg up is just slightly below this area. So that's why I've got this rectangle drawn across here, because that's an important area. But of course, the market has a lot of work to do before it can get to this area. It's got to overcome blue and climbing. It's got to overcome the step line. 24% Fibonacci retracement. That's the shallowest fib retracement, but it should be good support, should give us a bounce. Same thing at the 38% fib retracement. Then we hit the daily BBC, and that's almost always good for a bounce. As you can see here, we pulled back to it, got a bounce, didn't stick, but we came right back, and bounced again. And this bounce right here off the BBC has taken us from basically 3,900 to 4130, we'll call it. Now from 3,900 to 4,100, it's 200 points. That's 2,000 Dow points. There's a 10-to-1 relationship between the S&P and the Dow. So important numbers to note. Overhead, 4134 after today's high. And then support, basically today's low. And if we take out today, because the day's low lines right up with the step line, and so if we take that out, then we'll look for support down around 4060. It so happens that we have a weekly trading zone this week at 4066/67. As I say, fibs are an area, so it would make perfect sense for price to come down, find support in this area, catch a bounce, and then continue the decline down to the 38 and the daily BBC, catch another bounce. It's what happens once we get below the BBC that determines the final outcome of this thing. Now, we haven't done this in a while, so let's take a peek. This is a daily chart, but we're going to turn it into a monthly chart. And we'll turn it into an S&P chart. And we're going to have to use the continuous contract. Continuous contract allows you to pull in more data. It sews together, if you will, all of the previous contracts. We were trading March and we were trading June. Okay, it's a synthetic way of just connecting all of the individual contracts in the S&P, one after the other. You can't trade this contract, but you can use it for the purposes of charting. If you were to put this into your DOM and try to trade it, it would say you can't do that. You have to define the exact contract, like currently trading ESM 21, the June contract. But for the purpose of charting, we can run a continuous contract. We can shrink it up a little bit. That might be all the data it's going to give me. This takes us back to, try one more time. Yeah, that's as far as it'll take me. So we're back to March, April of 2016. So this is 5 years. Now, we have closed only 2 times below the BBC in 5 years. December of 2018, which, as I recall, was the worst December on history since 1932, and the pullback held. That's the really important thing here. The pullback to the BBC holds more often than it doesn't. It doesn't matter what time frame chart you're on. Everything we do is fluid across all markets and all time frames. Price flows on this monthly chart the same way it flows on a 1-minute chart. From resistance, support, resistance, support, looking for resistance. Think about this. If you had bought the S&P 5 years ago at roughly 2,000, here we sit at 4,000. The value of the S&P 500, that's 500 large cap companies, best of breed. Now, being included in the S&P 500 requires more than just a large market cap. There's a whole list of qualifications that the board over at Standard & Poor's puts a company through before they decide to accept it into the hallowed halls of the S&P 500. And in order for a new company to be brought in, a company that's fallen on hard times, missed their earnings, that type of thing, they have to be removed before the new one can be put in. The fact that we have held every pullback for the last 5 years is astonishing. I've only been trading futures since 2005. It's 15 years. We're only looking back 5 years here. Maybe I'll pull up a trading view chart in a little bit and see if we can't pull back in some even more data. But look at this leg. Tracement, leg, tracement, leg. Now, let me do something a little bit different. Let me try this. Let me see if I can make this work. Give me 1 second. Okay. All right. Stand by. Now this is a test. I told you there'd be a test. Who can tell me what time frame and what market that is? Give it a minute of thought. I'm going to save that. Put it here in my private channel. Okay. All right. Time's up. So now, I'll leave that there for a second. Okay, almost done. Sorry for the delay, but it's worth it. It's gonna make a really valid point here. Okay. Who can tell me what market and what time frame that is? Anybody want to guess? What market, what time frame? Think about it. All right, I'm sure you've made your best guess. Now, what market and what time frame is that? Okay, the easy answer is you don't know. There's no way you could know. That's a weekly S&P. That's a 1 minute crude. My whole point doing all of that was to just kind of drive home the point, the thing I cover every day. Price flows exactly the same on a 1 minute chart as it does on a monthly chart and a weekly chart and everything in between. If we drag this back up, and now you know it's a crude 1 minute, but what did price do? Price went from support to resistance, came back to support, resistance, support, resistance, and it's still looking for support. S&P went from support, resistance, support, resistance to support, resistance to support, resistance to support. And all along the way, it had, resistance, support. Now, you might be saying, well, okay, what's your point? Well, my point is, if you can embrace that price flows on every chart at every time frame exactly the same, which is, if you're new to trading, actually, if you've been around trading for a long time and no one has ever discussed that with you, you're like, no. A 1 minute chart is different than a monthly chart. Well, it is different because you're looking at the market under a 1 minute microscope as opposed to looking at it under a monthly telescope, if you will. You can see more data, but the flow, the way price moves from buyers to sellers, back to the buyers, back to the sellers. We give you weekly trading zones at the beginning of each week. That's your fixed support and resistance for the entire week. Carved in stone. Once we publish them, we don't change them. Not for the entire week. Every Monday morning at 6:15 a.m. Eastern, all of our traders get the new set of zones, and they hold on to the previous week's zones for the first few days, because a really strong area of support or resistance this week may very well carry over into next week. In fact, on Sunday nights, we are still using the previous week's zones. It's not until Monday morning at 6:15 a.m. Eastern that we publish new weekly zones. So those go on your chart right away. Now, does price really flow from support to resistance and back to support again? Well, let's go to our 30-minute chart. Take a look. Price dropped to the weekly trading zone, this week's zone at 4105/4106. Well, here's where the market opened on Sunday night. This candle right here. Okay, this was the open. So price went looking for support, which it found at the BBC. And it bounced up to an area that we expect to be resistance. We expect the step line to be resistance, and if we get through the step line, then we expect red and falling to be resistance. So from support, resistance, back to support, to resistance, to support, resistance, to support, resistance, support, resistance, to support. And then price did not do the next high probability thing right here. 20% of the time that happened. At this point, the high probability is that price would make it up to the zone at 4127/28. It didn't. Now, I could make up all kinds of reasons, some that sound very, very intelligent and sophisticated as to why that happened, but I'll just say the truth. At 41.24.5, buyers stopped buying. Why? Go ask them. Okay, there were orders in the DOM. If any trader on planet Earth, institution or retail, had wanted to pay 41.24.75, they could have. There were orders in the DOM. There was inventory. So we get into the realm of things that are unknowable. And traders have a tendency to spend a lot of time and a lot of treasure trying to know the unknowable. The sooner you accept the fact that there are things in the market that are unknowable, no indicator, oscillator, or algorithm can provide you with the answer, you have to simply just nod your head and go, okay, it's unknowable. That takes the sting and the burn and the pain out of when you get stopped out. Okay? Price is based on order flow. What is order flow? Order flow is all the buyers and sellers in the marketplace at any given time. When there's more buying pressure than selling pressure, price goes up. When there's more selling pressure than buying pressure, price goes down. It's that simple. There are a lot of expensive explanations of what I just said, but I just gave it to you for free. Not only was it free, it's the truth. Okay? Buyers were clearly in control. Look at this candle. And they drove this thing hard. Now, we were approaching the end of the session. This last little candle here, that's that final 30 minutes of trade, which is usually typically pretty quiet. So price drifted back to support at the BBC. We actually spiked below it a bit. But then buyers came in, took us to the tick, up to the zone. Fixed support and resistance. Now your indicators, the BBC and the CFMA1, which is this red and blue indicator, I refer to it as blue and climbing, red and falling. One is bullish, one is bearish. One represents support, the other resistance. Okay? And so we went from the zone at 41.27/28. That's a current this week zone. We dropped the zone below at 41.05/41.06. Support. Buyers came in, drove it right back up to resistance. Fixed. These numbers won't change all week. We send out zones for the S&P, the Dow, the Russell, the NQ, crude, gold, and occasionally I do silver. So, what's the next high probability move here? Well, since the market just found resistance, it's obviously looking for some support. Where would we expect to find support? Right here. The pull back to the BBC holds more often than it doesn't. It held here, here, and here, and here, and here. And for this pullback here, no surprise, it held. Bounced us up to resistance. And we're now pulling back, looking for support. How will we know when we found support? How did we know we had found support here? The color green. How did we know we had found resistance here? Color red. When price begins its pullback, once it gets below the step line and blue and climbing, both of which can act as support on a pullback, that would be minor. And the 30-minute BBC, that's major. It's not as major as the BBC on the daily chart. But for our purposes, and the fact that all alerts are based off of a 30-minute chart, we consider it major, okay? So, do we want to take any action right here? No. Why? Well, when we're above the BBC, we only want to buy the market. When we're below the BBC, we only want to sell the market. However, we would never buy a red candle. We want to see this red candle continue down. And then we catch a new candle. That new candle starts printing green. That's our indication the market has found support. And then we just want to catch that bus up to the next stop. Again, fixed support and resistance. I mean, this is such a wonderful example to be able to show you of price going from support to resistance, back to support, back to resistance, just using the fixed support and resistance. The indicators, BBC stands for bull bear cross, bullish above, bearish below, and the CFMA1, blue and climbing, red and falling. That's your dynamic support and resistance. And so the dynamic support and resistance operates inside of the framework created by the fixed support and resistance. When you start breaking it down this way, when you start seeing it this way and understanding what price is doing, what its objective is, what's mission critical, then you start to understand the different things that happen. And you're not, when you do get stopped out, that mule kick in the gut doesn't really hurt as much anymore. Oh, kick, where is thy sting? Because you already know that 20% of the time, price is going to do something other than the next high probability thing. Because we have a red candle, because we're below the step line, because we're below the BBC, the blue and climbing, we know that the high probability move is to the BBC. We're not going to trade that though, because that would be what we call a counter trend trade. In our alert channel, we launched Logic 247 141 weeks ago. There are over 7,000 individual alerts in that channel. And over the course of 141 weeks, on average, 20% of the alerts get stopped out because the market does something other than the next high probability thing. Also, every one of those 7,000 plus alerts are based on the prevailing trend as defined on a 30-minute chart using fixed support resistance and the BBC. This is an uptrend. Logic would only be looking for long trades here. Only looking for short trades here because we're below the BBC. Now, could I put out an alert that says consider being short 41.22 down to 41.20? I could, but I don't, because again, counter trend trades. Now, some people love them. That's their bread and butter. They specialize in counter trend trades. They spend their time looking for counter trend opportunities. And again, nothing at all wrong with that. Our strategy is different in that we look for trend trades. We like to have that bullish or bearish wind at our back based on the data. A trend trade is a higher probability of reaching its target than a counter trend trade. And that's just numbers. That's just data. It has nothing to do with, I just don't like counter trend trades. Because those who come to us to learn how to trade, the alerts are designed to give you samples to work with in the market. Because in the beginning, when you look at a chart, maybe it doesn't kind of make sense. Over time, you'll learn to read this like a newspaper or a mystery novel. And so when the alert sounds, we use Telegram as our messaging client to send out the alerts around the clock, 24/7, Sunday night at 6 p.m., Friday afternoon at 5 p.m. When you hear that Telegram sound, it's not a call to jump on a trade. It's a call to go to your chart. Study the alert, study the chart. Understand why that is a window of opportunity. Understand why that is a high probability, low risk window of opportunity. And then trade it in your simulator. When you first become a passport holder, you should not start trading real money right away. Doesn't matter if you have years of experience or not. You're just now learning our method, our strategy, how we think, how we see the market. And until you kind of get up to speed with what we're doing and how we do it, you should be trading in your demo account, simulator. Every new trader receives a 24/20 blueprint. That blueprint just maps everything out for you. The first thing the blueprint's going to ask you to do is put together 10 consecutive days in a row where you reach your goal in 10 trades or less. It's also going to assist you in writing your business plan, your trading plan. You need a business plan and you need a trading plan. Otherwise, you're just clicking the mouse willy-nilly without a plan. McDonald's has a business plan. And their trading plan would be called their operations manual. Starbucks. Every successful large company in the world has a business plan and some kind of operations manual, which for us would be called a trading plan. 9 out of 10 traders have neither one, which makes it no surprise that 9 out of 10 new traders fail. Think about that and then ask yourself, do I have a trading plan? Do I have a business plan? And they're two very different things. The business plan, let's say you're going to open a Subway franchise, right? Corporate, when they send you your franchise papers, they're going to send you a bunch of manuals. One is going to teach you how to operate the business, okay? How you hire employees, how you set up your bank accounts, how you do your accounting, all that kind of stuff, how to run the business. There's going to be another set of manuals, your operations manuals, that teach you how to make a tuna sub. And you might think, well, anybody can make a tuna sub. Right, but you need to make a profitable tuna sub. In other words, once you slice that bread and put it up on the counter, there has to be, on a foot long, there has to be exactly 3 or 4, I forget, leveled scoops of tuna on that bread. If you put 5 scoops, if you got some new employee who's could care less about your business plan or your operational plan, and their buddies come in and they're slapping 5 scoops, 6 scoops on, right? That's an unprofitable sandwich. And if you make enough unprofitable sandwiches, guess what? You'll go out of business. So everything's been laid out, mapped out, and this is what you have to do. This is your trading business. So the blueprint is going to assist you in writing the business plan, writing the trading plan. It is not something that you're going to accomplish in an afternoon. It's going to take you a couple weeks. It's also going to take you a couple weeks to put together 10 consecutive days in a row so that you can go live and trade real money. The first requirement of the 24/20 blueprint is that you put together 10 consecutive days in a row where you reach your goal, 10 trades or less. Once you accomplish that, the blueprint will then give you the green light to actually go live with 1 contract. Only 1. Now your goal is to increase your account balance by $2,000. Real money. 1 contract. Once you do that, once you've increased your account, doesn't matter what your starting balance was, whether it was $3,000, $5,000, $10,000. Once you've increased the account balance by $2,000, the blueprint will give you the green light to add a 2nd contract. Now, this is the game changer, okay? Because you're adding the 2nd contract with profit you earned trading 1 contract. 2 points a day in the S&P pays you $100. If you're trading 1 contract and you take 2 points out of the S&P, it's $100. 10 ticks in crude, 10 ticks in gold, 20 points in the Dow. All of those equal $100 per contract. In the beginning, that's your goal. S&P, 2 points a day. Obviously, in these days and times, unless you live in a third world country, cannot pay your bills and meet your daily needs on $100 a day. But you're simply laying the groundwork, the foundation for this trading business that you're building. When you increase, when the blueprint says, okay, it's time to add contract number 2, you're not going to change anything. You're not going to do anything different. You're going to do exactly what you've been doing. But the 2 points that you take out of the S&P are now going to pay you $200 instead of $100. Then the blueprint will give you the green light when it's time to add number 3, number 4, number 5. However, you only add additional contracts with profit you earned in the market. Say it again. You only add additional contracts with profit you earned in the market. And you only add 1 at a time. So you're not going to get rich overnight. If that's your thinking, then we're the wrong place for you. Okay? This is about building a real business with a firm foundation, 1 step at a time. So, start in SEM. When it's time, when you qualify, when you earn the right, you go live with 1. And when you've earned the right, you add a second. And when you've earned the right, you add a third. By the time you've earned the right to trade 10 contracts, those same 2 points that made you $100 in the beginning now pays you $1,000. The same 2 points. You don't have to get more points. You don't have to put on more trades. Now, some people do approach the market by always trying to get more points, more points, more points. That's the hard way. The simple way is to get really, really good at just taking a small bite out of the market each day, a small slice, 2 points. There's never a day that the S&P does not offer you multiple opportunities to take out a couple points. And the same is true of crude and gold and all of the markets. Okay, it's 10 ticks in crude, 10 ticks in gold, 20 points in the Dow. Multiple opportunities a day. You just got to, that's all you got to do. And then exercise patience and self-discipline. Don't overthink it. You don't have to go out and buy more stuff. Once you become a passport holder, your days of buying more trading stuff, it's over. Now, you might go out and buy something else, but you don't need to. You'll do it because you somehow don't understand what's already been put in front of you. Because what we put in front of you is what you need, everything you need to trade. We give you the information. We provide you with the tools. We teach you how to use the tools. The thing you have to bring to the table is patience and self-discipline. And those are the two things that we can't give you, loan you. You can't rent them. You got to find them inside of yourself. Now, we talked about price pulling back to the BBC. We said that's the next high probability thing. And we said that the pullback to the BBC holds more often than it doesn't. Okay. And we've said that when price rallies up to the step line or to blue and climbing, that's potential resistance. Now, this situation here, it's not going to be an alert. I'll tell you why. Because of the current market structure. Let's say price is able to overcome this potential resistance right here. This would be resistance times 2. Now, blue and climbing is considered support when it's like this, when price is to the left. See how price is to the left of blue and climbing? That's supporting the market. Okay, that's bullish. However, when blue and climbing in the step line get directly above price, the way it is right now, that becomes potential resistance. And look what happened. We hit the BBC, bounced just like we thought we would, and then we ran into resistance, just like all of our traders know to expect. And so the simple solution, if market structure were like this instead of like this, then we would be trading this window of opportunity right here. But because of market structure, we won't be able to do that. Because just as we knew this was potential resistance, this swing high is potential resistance. That swing high is potential resistance. That swing high is potential resistance. And so there's just no room left to put on a high probability, low risk trade opportunity. Over here, if the market had found support and bounced, it would have been a great opportunity to go long back up to the zone. But this is like a minefield, okay? So when I talk about market structure, this is part of what I'm talking about, okay? Market structure here would have been beautiful for a long, but price just didn't give us an opportunity to go long. Now, you've been sitting all morning, you know, getting a little weary, and so you go, you know, doggone it, I'm just going to take a shot. You can do that because it's your trading business. But if you do that, you've violated everything we try to teach you. And chances are, this foray into trading will end up just like the previous forays. It just won't work out. So you have to have the self-control to stay out of this trade. Had it played out differently, then you would have to have the courage and the faith in your method, in your definable edge, to without thought, just take the trade. And while this would have been a perfect scenario, 20% of the time, something is going to happen. Support and resistance can show up out of nowhere at any time. Now, so far this week, and this has been a difficult week, okay? It's been a difficult week because of this. This melt up, okay? We have been since this candle, April 1st. Looking left, there's nothing to see. Looking left, there's nothing to see. Nothing to see. But on this 30-minute chart, when we look left, there's things to see, right? Now, on this move, you see that high right there, 41.25. We would need price to get above that to take this long, and there just isn't enough room to run. But because you now have this separating you from this, you only need to focus on this. And so again, the market did not hand us this opportunity, which we would have loved to have been a part of. So now what? Okay. We need to see price either fail here, which would give us an opportunity to be short the market. Price has to be below the BBC for us to short. And there's a great shorting opportunity down here. But before we can take advantage of it, we need price to fail, get here. Why down here? Well, the low of this candle is 41.15.5, which is right there. Can't see part of it because it's behind the step line. That has a high probability of being good support. I would even bump this down a little more. Now, based upon how the market shakes out, we could have an opportunity, something like this. We're sitting on top of support, we're consolidating. So the big question, are we going to get above this zone? Because the next zone overhead is up at 41.48/49. Fixed support and resistance. That number won't change all week. 41.47/48. Is it possible to just trade from zone to zone? Well, we did go from zone, back down to the zone, back up to the zone. So the answer is yes. But you got to keep your eye on the BBC. Bullish above it, bearish below it. So prices got to get below the BBC. The trigger here, to take us here, to potentially take us here, which takes us right back to support. Okay. Now again, you don't have to catch this big move. You don't have to trade this thing from zone to zone. As time goes on, if you acquire that skill level and you're capable of doing that, more power to you. In the beginning, keep it simple. Take the simple approach. Even if you never become an awesome trader, whatever that is, you can learn by applying some very simple guidelines and the use of our indicators. You can learn how to take a couple points a day out of the market. No magic, no parlor tricks, no nonsense, no BS. Learn to read the chart, understand how price flows, and understanding how price flows is pretty simple because it's the same on a monthly as it is on a 1 minute and everything in between. Same on the S&P as it is on crude. Remember when I showed you those charts, you could not tell me what market, you could not tell me what time frame without the labels, without price, without the time across the bottom, because markets are fractal in nature. All right. Now, so far this week, since Sunday night at 6 p.m. Eastern, on this quiet week, we have issued a total of only 17 alerts. Today's Tuesday. There have been weeks when we've issued as many as 20, maybe even 25 alerts on a Sunday night. That's dictated not by our desire to put out alerts. It's dictated by the movement of the market. We only post alerts when a high probability, low risk opportunity shows up. Plain and simple. If there is no high probability, low risk trade setup, then there will be no alert. Now, as you learn the methodology and the strategy, you don't have to wait for an alert. Our goal is to teach you everything we know, show you how we think, show you how we take action, and then you learn to do that yourself. Okay? When an alert is published, if you understand the methodology and the strategy, you don't have to wait for the alert to trigger to get long or get short. But when I send out an alert in the logic channel, I have to build in time for you, whoever you are. Finish what you're doing, get to your chart, study the alert, because this is a learning process. Okay? We're not just handing out alerts that you can trade for fun and profit. I know that's what some traders do with them, you know. It's your passport. You can do with it as you will, but my encouragement is that you use it as the learning experience it was created to be, so that you reach a point, at some point, where you never again need anybody. No man, no machine, no tip sheet, no nothing to tell you when to get in and when to get out. You sit down, you look at the chart, you see the opportunity. You know, going in, there's a 20% chance that the market is going to do something other than the next high probability thing. You will learn over time to not focus on the outcome of the next trade, because that will make you nuts. You'll learn to focus on the outcome of the day, the week, the month, the quarter, whatever measuring stick you use. But if you live and die by the outcome of the next trade, if your belief in yourself and whether or not you can actually become a trader hangs in the balance of the outcome of the next trade, you got to stop. Hit pause. Back up. Book a mentoring session. Let me or Michael or Valerie or Bert help you get a fresh perspective on things. Because you're doomed. That's a terrible word. I'm not a prophet of doom. I don't want to be. I don't want to be Mr. Doom and Gloom. But if you're approaching that market, each day waking up wondering, is today the day to blow up my business or not? That's the first thought that pops into your head. Stop. Do not put on a trade. Hit pause. You've got to get a fresh perspective on the markets. 17 alerts issued, still waiting on 2. 14 actionable. 2 stopped out. 14% of actionable alerts stopped out. The average week, 20% stops out. Okay. Now, in the room in the morning with Michael, he teaches you the importance of always having a physical hard stop. His primary focus is teaching you the setup. We use the same setup on every market, on every time frame. That right there makes things pretty simple. Okay? Same setup on every market, on every time frame, over and over and again. Now, while he's teaching you the importance of always having a hard stop, we want your focus to be on learning the trade setup. So as you're learning, you're going to use an 8-tick hard stop on every trade, on every market. S&P, gold, crude, doesn't matter, 8-tick hard stop, period. Once you learn the methodology and learn the strategy, I'll start to teach you about market structure. And as you move into larger time frames, if you choose to do that, you can stay with the mechanical model forever. There's nothing wrong with that. You do not have to move beyond. If you choose to trade the alerts, if you choose to learn about market structure, I will teach you. And the market will tell you where the stop needs to be. With the alerts, we do not want to risk more than $300 per contract per trade, but less when possible, based on the structure of the market and the 3-step method that we teach all of our traders. Now, when you go to your chart and you spot your entry, the chart will tell you that if you're going to enter here, your stop loss needs to be here. If it's more than $300, you're going to go to step 2. If it's still more than $300, you're going to go to step 3. And if it's still more than $300, you're going to pass. Important prices, important areas are almost always tested. What that means is that once an alert triggers, there's a greater probability of it triggering multiple times and not triggering multiple times. And so you see the setup, you see the entry, beautiful thing. You apply the method. Step 1, nope. Step 2, nope. Step 3, relax. Be patient. That alert will most likely, in most cases, trigger again, and sometimes again. Many days, when I go through the recap, we see alerts trigger 2, 3, 4, 5 times, even more. Okay? Not all triggers are created equal. I'll show you that as we walk through the chart. So again, for logic this week, a very light week so far. 17 alerts, still waiting on 2, 14 actionable, 2 stopped out based on that $300 risk profile. Now, the companion to the logic alerts, in fact, it was our original alert service, the concierge trade alerts. These are different. These are based on historical price action. The logic alerts are based on current price action. These are based on historical price action. When you've got the current and the past pointing you at the same important price, important area, that means it's pretty important. So you want to slow down and really focus in on that. This is forward guidance for the entire session. This does not come out around the clock, 24/7, like the logic alerts. This comes out once per session, shortly after the Globex Open. Last night, it was 10 minutes after Globex Open. There's two numbers for each market. The best way to handle this is go to your chart and put a line in the sand at 41.31. Put a line in the sand at 41.12. If price starts trending up to 41.31, that's bullish. Logic will attempt to find opportunities, windows of opportunity, to buy the market. If price starts drifting down towards 41.12, that's bearish, and logic will start looking for opportunities to sell the market. Bullish, bearish. Once price reaches 41.31, that becomes a dividing line. Market is forced to make a decision at this place right here, 41.31. It can be like an iron curtain that turns price and sends it in the other direction. Or it can be a gate that swings wide, and above 41.31, we're only looking to buy. Below 41.12, only looking to sell. Put those lines in the sand for each market that you actually trade. Now, see, someone has their hand up, but if you have a question, and sometimes that gets clicked by accident. So if you have a question, just type the question in the chat box. I'll be happy to answer it for you. Okay, so I see the hand. I don't see whose hands are raised. Looks like Randy. Randy, if you have a question, just type in the chat box. I'll be happy to answer it for you, okay? All right. So now, if you want a screenshot, grab them, grab it. We'll go take a look at the chart. Okay. So the CTA last night for the S&P 500 E-mini futures was to be long at or above 41.31. And we can see that once again, it didn't trigger. These last 2 weeks has been the longest stretch of non-triggering CTAs that I think we've ever had. And we've been publishing the concierge trade alerts now for 7-8 years. Now, there were logic alerts. The CTA, which is forward guidance for the entire session, did not trigger. Short side is 41.12. That did trigger. Now, on a short alert, the final trade to target is always the weekly zone below. On a long alert, the final trade to target is always the zone above. Logic alerts often will have multiple targets. You have an initial target, second target, a third target, fourth target, whatever market structure calls for. And then the weekly trading zone is the final trade to target. And so, in this case, the zone is at 41.05/06. So from 41.12 to 41.06, that's a 6-point drop. 6 points at $50 a point. It's $300 per contract traded. If you've earned the right to trade 2 contracts, then it's $600. If you've earned the right to trade 3 contracts, it's $900. It's the same 6 points. The number of contracts determines the amount of profit or loss in any individual trade. Now, I did say important prices, important areas are almost always tested. So after we go down and ring the bell, now this thing continued dropping for another 5 points, 4 points. But then it got back above the trigger. See right here? When this candle opened, high of this candle, it's 41.1275. It got 3 ticks above the trigger, and then it retraced. See, this was a green candle all the way up. Then it dropped below 41.12, triggering again. This time it dropped to 41.07. So that's a 5-point drop. But we had 2 triggers off the 1 alert. Now, some days we'll see 3, 4, 5, 6, however many. Just know that once an alert triggers, there's a greater probability of it triggering multiple times than not triggering multiple times. Just like a pullback to the BVC will hold more often than it doesn't, as you just saw here. Okay. Price is pinched right between the step line and blue and climbing. Now, because blue and climbing is above price, directly above it, not beside it like this, but above it, that represents resistance. And we've already discussed why we're not going to turn this into an alert in the alert channel. Because this swing high could be resistance. This swing high could be resistance. And we fully expect the zone to be good resistance until proven otherwise. What does that mean? Well, let's say price gets up here and consolidates for a bit. Then we get a little leg. We get a retracement. And then we continue higher. We could consolidate here for 1 candle or 100. Once we move above it, go back to it, start to move higher. This is where we want to engage with the market. And if price is able to take out that swing high, then we have no problem just staying with it. Because once this support is identified, the hunt is on for resistance. And you can stay with it until resistance is found. Or you can get out at any predetermined point. Remember, most logic alerts will have, they all have an initial target, and most of them have a second, a third, sometimes even a fourth and a fifth target before you get to the fixed resistance overhead. In this case would be 41.47. So we've had no trigger on the long side, 2 triggers on the short side. Let's go to the Dow. CTA number on the Dow last night was 33,725, which never triggered. Had it triggered, the target would have been 33,750. Short side on the Dow was 33,540. 40. $33,540. Okay, the initial drop from 540 took us down 460. That's an 80-point move. At $5 a point, it's $400 per contract traded. Price retraced to red and falling and the weekly zone. Remember, when price moves up to a zone, we expect it to be resistance. When price drops to a zone, we expect it to be support. Okay? Only 3 things happen at a weekly trading zone. The most likely thing is consolidation. You're going to see that over and over again and again. Second most likely thing to happen is rejection. Okay? Now, this zone is 420/425. Okay? When a 30-minute candle closes and the only thing left touching the zone, in fact, let me just do this. $33,425. When this 30-minute candle closes, if the only thing left touching the zone, and zones are an area, so it missed it by a few ticks. That's called rejection. Only 3 things happen at a zone. 75% of the time, consolidation. 20% of the time, rejection. And the third and final thing that can happen is called a slice. That's when price slices through a zone like it's not even there. When that happens, most of the time, after a slice, when that slice runs out of steam, price will retrace to the zone it sliced through and then continue in the direction of the slice. This is a picture-perfect example of what happens on a slice. Slice through, pull back, continue in the direction of the slice. So from 540, we drop to 460. That's 80 points, $5 a point, $400 per contract traded. Back above the trigger, trigger again. This trigger dropped almost to the zone. 425, 525, 100. It's about 115 points. $5 a point. It's a little over $500 per contract traded. But we're not done yet. 1 trigger, 2 trigger. We get 5 points above the trigger and drop again. This time the swing low is 33,440. So 100 points. $500 per contract traded. 1, 2, 3 triggers, 1 alert. Fixed support, fixed resistance. Pull back. What was support became resistance. Remember, these weekly trading zone numbers do not change for the entire week. On Friday, we'll still be talking about these same numbers. The weekly zones, Monday morning before Wall Street opens for the week, provides our traders with sort of a layout, a playing field, if you will. It's like you're sitting at the football game, at the 50-yard line. You look to the left, you got the 40, the 30, the 20, the end zone. Look to the right, you got the same thing. And price is going to move back and forth, back and forth. Every now and then, the ball will run off the field. Last week, we had a couple of markets that closed above the highest weekly trading zone for the week. That's unusual. We've published the zone since December 14th of 2009, well over a decade. We're coming up on 12 years. 2009. Yeah, coming up on 12 years. Okay, so what's the high probability move from here? Well, price has managed to get above red and falling. If it can get above the step line, then there will be a counter trend move because the trend is down because we're below the BBC. So if price can get above the step line, which is potential resistance, it's going to run into the BBC, which is potential resistance. In fact, we fully expect, until proven otherwise, that price continues to rally. If buyers are committed, they're going to hit this area resistance. Now, if it takes it an hour or so to happen, this BBC is going to continue to drop. And so it could be that price just pulls up to the BBC, finds resistance, and creates that next leg to the downside. So we've had a leg, a retracement, a leg, a retracement, leg. Now we're in the midst of a retracement. Some would say, well, gosh, why not trade this? You think it's going back to the BBC, why not trade that? Well, you can, okay? Once you learn the methodology and the strategy, if you want to trade counter trend trades, you can. I'll even help you in a one-on-one mentoring session because you have unlimited access to them. If you want me to teach you that, I will, but I'll also remind you the highest probability, lowest risk trade setups are based on trend, not counter trend. Doesn't mean you can't make money counter trend trading, because you can. Okay? But for those of our traders that are new and are just learning, I want these alerts to be of the highest probability, lowest risk caliber that I know how to find. So every alert that goes in the channel is my best work. 20% of the time, the market does something completely different. Okay? That's the nature of the market. If you're still spending time and treasure trying to find that thing out there that allows you to just trade and not get stopped out, it doesn't exist. It defies the laws of physics and science and God. It's not there. It's like looking for a black cat in the dark that isn't there. You cannot find what does not exist. Period. So we'd like to see a nice bounce, and that will give us an opportunity to go short. Here's the thing though. Look at red and falling. See how it's starting to curve? Okay. You see how it's below price? So if we come back up and get a trigger and we short it, gotta remember that coming down this step line and this could become good support. In fact, about 2 candles from now, if the market were to just go sideways, this is going to do this. It's going to turn into blue and climbing. just like blue and climbing, comes into red and falling. Kind of like the old follow the bouncing ball kind of thing. So right here, market dealing with resistance. It can overcome this and this. It'll put us here. And from here, the high probability move is another leg to the downside. How far will it go? Depends upon the buyers and sellers in the marketplace, from the retail trader all the way up to the largest institution. Fred has a question. Fred, when you have red and falling, you don't worry about the step line being in the way on the YM? I'm guessing, are you talking about this retracement here? Okay, on the way down, I think I understand your question. On the way down, could the step line have become support? Yes, it could have. That's your question. You're absolutely right. However, from the trigger at 540 down to the step line, it's about 35 points. See, the high of this candle is 545, the low is 500. So you've still got an opportunity to take out 45 points before you get to that potential support. But yes, very good. I'm glad you caught that. That could have been support, but we breezed on through it. Just like coming at it from the other direction now, it can be good resistance. And it seems to be. Market seems to have come to a halt. If we can overcome that, then we've got a straight shot up to the BBC. Although, don't count out this candle, because when this candle opened, it was green for a minute. That little wick right there, the market tried to go higher and failed. So when price revisits that area, 33,515, we want to be wary of that. Okay. It's like buyers are coming to life. But anything on the way up is counter trend. Now, let's say price climbs and climbs and climbs. Once we're above the BBC and above this weekly trading zone, now we would be looking for long trades versus short trades. And so if we're able to trade long here, we just have to be careful of this area here. A bearish cross that leads to an extended move, when price comes back to that area, it will most likely be resistance, at least the first trip up. Okay, so that answer it for you, Chris, Fred? Okay, good question. Thanks very much. Okay, let's hustle on and... Okay, now the S&P's made it to the zone. Okay. Now, I know what a lot of people are thinking, because I'm a people too. Man, I should have took that trade. Look at it. It ran right to the zone. Okay. And this is one of the things that makes learning to trade difficult, because this hindsight. Oh, man. Yeah. But that does not, just because this time it shot right up to the zone, that does not take away the fact that that could be good resistance. That could be good resistance. That could be good resistance. It doesn't change that. It just so happens that this time it didn't. And so with the alerts, what I'm trying to do is I'm trying to find areas for you guys where there are no obvious areas of potential support and resistance. Clear sky, or clear water, as I once heard it said. And this was kind of like walking through a minefield. Okay, so now that brings us to the next question. Can we overcome the zone? The zone is 41, 27, 48. In my perfect world, I'd like to see a price, get above it, hold a pullback, and then start pushing higher. And we've got the CTA right here. Now we know the CTA can be like an iron curtain that sends price in the opposite direction. But if we can get above that CTA number and hold a pullback, because we are at all-time historic highs, this is a great, big, huge window of opportunity. That would most absolutely become an alert. 41, 35, 35 up to 47. Or you could call it 45, keep it simple. Zones are an area. 10-point window of opportunity. $50 a point, $500 per contract traded. And there's no caveats up here. That opportunity up there, for me, is as good as it gets. I just need to see us get above the CTA, hold any pullback, continue higher. So, I mean, you might not have to wait to 35 to get in. You could, market structure could get you in, at 33. I don't know what market structure will look like until price gets there. Okay. All right. So the Russell numbers on the Russell last night, CTA numbers, long above 2246, touched, short below 2224. There's 2224. Okay, on the first approach, dropped 1 point. We're looking for 2. The initial target was 2 points. We only dropped 1 point. But on this trigger, we dropped all the way to the zone below. That is a current weekly zone. In fact, we sliced through this zone, and when the slice ran out of steam, it retraced back to the zone it sliced through. Then it continued in the direction of the slice. So this trigger, maybe it just ended up in a stomp out. Maybe you didn't trade it. This one took us from 24 to 08. So that's 16 points at $50 a point. Price gets back above the trigger. Triggers again. This time it takes us 22.24 down to 22.13, 10 points. And then it gets, well, actually it continues, because when this candle closed, it opened here, it continued down to the zone below. So actually it did the same thing as this, it's just spread over 2 candles. This red candle stopped here, opened here, continued down. This was a red candle. Then price rallied back up to where this candle opened, became a green candle. Then we triggered again. And this trigger took us from 24 down to 19, 5 points. Then it got back above the trigger. Did it again. So we had 1, 2, 3, 4 triggers, 1 alert. Oh, 1, 2, 3, 4, 5 alerts total. Okay. Now, that's a lot of points. But I just want to remind you, you don't need a lot of points. What you need is a couple points consistently, day after day after day, like clockwork. Using the profits to add another contract. Using those profits to add another contract. Using those profits until you build up your account size to, wherever you're comfortable. A lot of traders, once they reach 5 contracts, that fits their lifestyle, all their bills get paid, 2 points a day out of the S&P at 5 contracts. It's 500 a day. It's 2,500 a week. Some people get comfortable at 10. Okay. At 10 contracts, 2 points a day. That's $1,000. It's $5,000 a week. It's $250,000 a year. That puts you in the top 3% of wage earners world. So you can try to get as many points as you want, as you can, or you can get really, really good at taking a couple points out of the market. And over time, increase the number of contracts traded. It's your trading business. You can do it any way that you want. Make sure you have a business plan. Make sure you have a trading plan. And then make sure that you stick with the plan. The plan is no good if we don't follow it. Okay. Next is the NQ. Okay. The CTA long for the NQ last night was 13,850. Right here. And the trade to target would be just 25 points overhead at 75. But this is what I was talking about I'd like to see on the S&P. Close above the zone, pull back to the zone, and then continue higher. Sweet spot here, of course, would be get a leg, get a retracement, get a continuation of the leg. Now the numbers for the NQ again, 13,850. Go to 875. That's 25 points at $20 a point, $500 per contract traded. But yes, it continued on substantially higher. Now we've got a little double top going on in the NQ. Short side on the NQ last night was 13,750, and we never got down there. This vertical line separates yesterday's session from today's session. Okay, just a couple more real quick here. Crude oil. CTA number on crude last night, long 59.95. Again, this line is when today's session opened last night at 6 p.m. Eastern. And the number was 59.95. All right, 59.95. Okay, the first trigger took us up to 60.11, or we call it 60.10. 15 ticks, $10 a tick, $150 per contract traded. And then we pull back to the BBC where we find good support. Pull back holes more often than it doesn't. Back above the trigger. And this takes us up to 60.17. So we'll call it 15. Basically $200 per contract traded. Back below the trigger. This one's a little bit different. Okay. We did go from zone to zone, but over here on the long, we want blue and climbing. We had it. Blue and climbing. Yeah. But here, red and falling. But red and falling is below the trigger. And so using your own judgment as you get experience with the methodology, the strategy, how we look at the markets, you might want to let price clear this area, because remember, red and falling, it's bearish. Okay. Price can overcome it. It does it all the time. But you don't know if this is one of those times until it does it. So it does overcome it. It does take us to the zone overhead at 60.35. And then it gets back below the trigger. Off we go again. So we're from the trigger to the zone, back below the trigger, back to the zone. We didn't quite make it all the way back to the trigger this time. Trigger is 59.95 and the swing low was, well, 59.95 on the nose. Like to see it, dip below by just a little bit like this. So if you took it, the thing is you have blue and climbing from the trigger. You've got blue and climbing over, the BBC, which when we approach from below, we expect to be good resistance until proven otherwise. So on this, you might not have entered. You shouldn't enter until you get back above the BBC. Because when you're down here, heading up, you got to expect that to be resistance until proven otherwise. Okay, gold. CTA last night on gold was pretty long, 1750. Never reached. And then on the short side, 1729. All right, 1729. Now this first trigger, it dropped exactly 1 point from 1729 to 1728. $100 per contract. Gold pays $100 per dollar of movement. Crude pays $1,000 per dollar of movement. Silver pays $5,000 per dollar of movement. But with gold, 1 point, $100. So we get back above the trigger. We find resistance at the weekly trading zone. Oh, you know what? That's last week's weekly trading zone. So let me make that yellow. And then the next zone overhead for this week is 1744. Then we got this week's zone at 1731. And then below that, 1714/50. All right. Again, CTA number 1750. Haven't reached it yet. On the short side, 1729. So we dropped to 28, $100. And we did it again. This time I made it down to 24. So from 29 to 24, it's 5 points, $100 a point, $500 per contract traded. We get above the trigger, drop again. This time from 29 down to 25. We'll call it $400. And now the question, will this become resistance? Price trades through it, and we hit the CTA, which again could become like an iron curtain, send price back down. Price could get above it and hold a pullback. That opens the door to the next zone overhead, which is 1754. There. And so CTA trigger, zone overhead. Price can get up there. Nice window of opportunity. $300 per contract traded. All right, we got one left, silver. Let's see what silver's doing. CTA last night for silver on the long side was 25.04. $25.04, we ran up to 54. That's 50 cents. That's $2,500 per contract traded. Right there. And then when the move ran out of steam, price started to walk sideways. Now on this trip up, you'll see the step line here is on the left side of blue and climbing. But as price starts to walk sideways, the step line goes from the left side to the right side. And once the step line is on the right side of blue and climbing on a long, you're looking for the first red candle that closes below that step line. That would be right here at 25.39. So yes, the swing high was 54. The exit signal came in at 39. Did you leave a lot on the table? Don't think that way. Okay? You chose to stay with the trade. You're very, very happy with what you took out of it. Could you have gotten out here? Yeah. Or here, or here, or here. It's your trading business. You call the shots. You make the decisions. Once you make a decision, live with it. And if the situation calls for it, learn from it. Okay. What's price doing now? It appears to be retracing to the BBC. And if it does, and if it finds good support, I'll most likely put an alert that would take us back up into this area right here. Can't say for sure until price gets here, because only then will I know what market structure looks like. I know what market structure looks like now, But I don't have x-ray specs like Superman. I can't see into the future. I don't know what it will look like when it gets here. But if we just had a simple drop and started printing a green candle, we'd want to get over that step line and then trade the window of opportunity between the step line and blue and climbing. And then, of course, if blue and climbing is taken out, then we got lots of wide open spaces overhead. Okay. Around the world, all the markets. If having this type of information at your disposal, if having 24/7 around the clock 365 support would help you, if knowing where fixed support and resistance is at the beginning of the week, good for the whole week, if having a methodology and a strategy that isn't constantly changing, there's never any upsells, there's no new discoveries, there's no you gotta buy this, none of that nonsense. If you'd like something like that, you can have it. It'll cost you, but you can have it. It's at eminifuturestrading.com. You get live classroom instruction 2 hours a day every trading day. Watching videos is cool, but you're never going to learn how to trade watching a video. Having a teacher who you can ask questions while he's teaching, that's a great start. But then you got to get in the water. That's why you have a demo account, a simulator account. Hit the ground running, start trading. Of course you'll make mistakes. Good news is it won't cost you any money. Trade, 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 trade. Learn to see the windows of opportunity. Learn to recognize what a high probability, low risk trade setup is. I'll never forget when I first started trading. I'd hear these guys talking about, oh man, look at this setup here. It's incredible. And I'm sitting there going, it is? To myself, I didn't want to seem like, it is? I wonder why. Guys are all foaming at the mouth like, man, this is some awesome. I don't get it. I see a red candle. I see a green candle. I see some squiggly lines. What is it they're so excited about? It was quite a journey. Because back then in 2005, there was nobody willing to just take you by the hand and teach you how to trade. I mean, there's plenty of gurus and chat rooms and gazillion indicators and oscillators you could buy. There wasn't anybody who would actually invest their time in your life and help you learn to trade. This wasn't there. I know because I looked. I had a radio program. And I put out a bounty. And I'm not cheap. I offered good money for somebody to do what I just explained, to do what we do right now for you. Not available. No room at the end. So Michael and I had to do it the hard way. You can do it the hard way, or you can do it the simple way. Because I promise you, there is no easy way. Anybody tells you there's an easy way, please have them call me. I'd love to talk to them. All right, let's go to our good word for the day. Wrap this up. I don't know if you know, but just as there's a Bitcoin futures, there also, I think it started this week or last week. Let's find out. Come on. ETH. That. There it is. Probably not the right contract. Oh, maybe we can just do this. Yeah. Maybe this would help. Oh, that's much better. Okay. Let's So, when did this start? I guess February 12th was when it rolled out. Gosh, I didn't think it had been around that long. Maybe they're just providing. I don't see how they can do that. But anyway, just as there's a Bitcoin futures contract, there's an Ethereum futures contract. And it's pretty expensive to trade. But it is available. So just thought I'd throw that out there in case you didn't know. All right. Good word for the day. Yesterday we talked about grace. Today we're going to talk about turning a loss into a gain. That sounds good, right? Jephthah, a brave soldier from Gilead, was the son of a prostitute. Judges 11:1. Jephthah was the illegitimate son of a man called Gilead. His mother was a prostitute. When he grew up, Gilead's legitimate sons turned on him and chased him away. In Judges 11:12, it says, "You will not get any of our father's inheritance." So he ended up living in a cave. While there, he took a band of misfits and rebels and developed them into a great army. When the Ammonites threatened Israel, the elders turned to him for help. But Jephthah said to them, "Aren't you the ones who hated me and drove me from my father's house? Why do you come to me now when you're in trouble?" "Because we need you," the elders replied. "If you lead us in battle against the Ammonites, we will make you ruler over all the people of Gilead." It's in Judges 11:7. Not only did Jephthah lead them to victory, he's named with honor in the Bible along with people like Abraham, Moses, and David. His life is rich with lessons. Here's an important one. Rejection can be a part of God's plan for your life. Jephthah was rejected for reasons beyond his control. He was illegitimate. But instead of growing bitter, he moved on. He just went ahead and did something good with his life anyway. Perhaps you've been rejected. Maybe because you're old or young, because you're a smarty pants or dumb. Maybe you're pretty, maybe you're ugly, maybe you're privileged, maybe you're poor. Attractive, unattractive, male, female, white, black, etc. But by God's grace, Jephthah took an ugly situation and turned it into a beautiful one. And if you'll turn your situation over to God today, the same grace is available to you. And that's our good word for the day. Thanks so much for tuning in. Whoever you are, wherever you are, may God continue to richly bless you with his mercy and with his grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading E-mini futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.